Good morning.
Good morning.
How's everyone doing this morning? After a good long weekend. My name's Tom Ming. I'm with Tower Rock Advisors, and I'm here today to talk to you about the first quarter webinar. We're going to do a webinar every quarter to talk about trends in the financial markets and retirement, more importantly. And then today we're also going to talk about the newest fee disclosures. So with that, we'll proceed. Again, Tom Ming, Tower Rock Advisors. Tower Rock Advisors is a registered investment advisory firm that just specializes in helping plan sponsors and plan participants within corporate retirement plans achieve retirement readiness. So a lot of people think that since we're in the financial industry, that we trade stocks and bonds, and actually Brad said, hey, what about the currency and the yen? It's real specialized, because the industry is so diverse. So that's what we do. That's our specialty. We work with over 50 corporate clients and handle a lot of assets, and our goal is to get plan participants ready for retirement. So today, as mentioned earlier, we're going to review 2012, and we're going to look at trends for 2013. Why fee disclosures? We're going to talk about that. There's been some, initially, whenever there's fees disclosed, there's some hesitation or there's some curiosity. Well, there's been a curiosity for a long time on what fees are involved in all the financial products. So we're going to go into that. And then participants' retirement readiness. That's the single most important thing that we're going to discuss on a quarterly basis, is getting people to save and get ready for retirement. That's the biggest issue we have. I don't know if anybody listened to, I think it was Jay Leno, but Bakersfield is now the least literacy city in the United States. Okay, people aren't getting it, so we're continually trying to drive and get people to save and focus on saving for themselves so they can have a brighter future. Anybody hear that? Yeah. It's all around, yeah. What's that? Yeah. So here we go. So last year, a review of last year, the S&P 500, 14.28%. If you take a look at that chart since 2007, the market, it's like a big V. And we are completely back above when the subprime mortgage mess and the financial crisis and all the banks were going bankrupt. And so we have completely recovered over the last 5 years. Last year in particular was a really good year. But I can tell you when I talk to participants on a weekly basis, and I asked them probably in mid-June of this year, where do you think the market is? Most people said, probably flat to maybe a little bit above. So our perceptions and all the news that we hear on a daily basis really jades our views of actually what's happening out there. Okay? So it's really important to understand that our economy has recovered since the crisis, the financial crisis. Is it a bull market? Probably not a bull market. It's more of it's a recovery. It dropped so precipitously fast because of what was going on that it's almost a recovery versus a bull market. But when you take a look at what's driving this market, it's corporate America. Corporate America is more flush now than it ever has been in the history. They have more cash on the sidelines. They're making more profits than ever. So, so this year is just an indication that the market is recovering versus being a bull market. So what are the trends that we're looking at going forward? For the next couple of years, the U.S. economy growth may remain below the long-term trend until the debt reduction initiatives are put in place by the Federal Reserve. Just to boil it down, the next 2 to 3 years, We're going to work on debt crisis, getting things under control. And then after that, say late 2015, early 2016, all analysts are saying this, that we could be in for a really, really good market for an extended period of time. Okay? There's a lot of things that are causing that. Housing, for example. 50% of people in their prime ages that buy a house normally, like it's 25 to 35 years of age, half of them do not own a house. So, there's going to be a lot of housing demand that's being built up, and by 2016, 2017, we're going to see the housing recovery. Autos. Half of the autos on the road right now are 11 years or older. That's incredible. So by 2016, 2017, they're going to start buying more cars. Biotechnology and the energy logistics industry is going to continue just to thrive. What we don't see on here is technology. The cloud. The cloud's going to drive everything technology-wise. So it really looks good for us for the next 15 years. Next couple of years, it's just going to be rough waters, sub average returns. So maybe they're looking 3 to 5%, 6% returns for the next couple of years. But after that, we're looking for a really strong economy. Europe and China. This is the negative and positive of the world economy. Europe's policymakers have shown that they stand behind their union. The problem with Europe is they're not like the United States. Where the United States can put something in place, and all 50 states have to go by that policy. Where the European Union has Greece, which their people work about 4 hours a day and take 8 weeks of vacation. And you have Germany and a few other countries that are fiscally very responsible. So you have countries that are fiscally very responsible carrying the slack of, the Greece and Spain, where they aren't fiscally responsible. So it's going to be really hard for them to get out of the way of themselves. I mean, they're going to, it's, the most analysts that I've kind of listened to here in the last several weeks think that eventually this thing will break up, just because the fiscally responsible countries like Germany will not stand to continue to pay the debt on countries that aren't. China on the other end, and India, I mean, these are the companies that are growing, making the world, really dragging the world economies with them. They are growing faster than any other economies, along with Brazil. And over the last 12 years, they have really helped out us in the market, because the emerging market, developing market, and world market funds that we invest in have a lot of China, India, and Brazil exposure, as well as Mexico, and they've been very good to us. They are slowing down a little bit, but China and India will be the beast for the next 40 years for the world economy. So if I had a chart, and I don't, but it shows the gross domestic product of China and India versus the rest of the world, and they're about 40% by 2050. So just those two countries will dominate the world. Interest rates, inflation, and currencies. I'm not going to go into currencies, but the developed world interest rates are likely to remain low, and the inflationary pressures muted for the next couple of years. They think interest rates are going to start climbing late 2015, early 2016. The decade-long weakening of the U.S. dollar is probably ending as a trade and currency accounts balances start to improve. So, we still have some time. If you haven't bought a house, if you haven't taken advantage of low interest rates, now's the time. Now's the time to do that, because we're never going to see interest rates this low again. I mean, they're artificially low to stimulate our economy. If they're higher, if they increase, It costs more to borrow money, which slows the economy. So they are temporarily low to get us out of this mess that we've been in, okay? So you just have to remember that these low interest rates are probably not coming back during our lifetime. It's the biggest point I want to make today is if you haven't bought a house, buy one here in the next couple of years. Probably the best investment you can make. Second topic is fee disclosures. I think fee disclosures are fantastic. Thank God they finally came out with disclosures on what people are paying for their financial product or their mutual fund, okay? Why did this happen? Well, this happened because of the Financial Reform Act. When this whole market started to crater in 2007, the subprime crisis, banks were going bankrupt, large investment firms were going bankrupt, and they said, okay, enough's enough. We're going to have all financial products disclose what it costs in a dollar amount to invest in their products. So when the 401k, it's an investment product, we will receive an annual notice that clearly discloses all the fees within the 401k plan. This is good. It's going to make, it's going to make the 401k more efficient, and it's going to bring down the prices. Whenever there's disclosure, it brings down the price, right? As soon as you know what you're paying for, you're going to try to get it a little cheaper if you can get the same product, okay? So just remember that. So when you get the fee disclosure, keep it, look at it, okay? Look at what it costs you to invest. I can tell you from WorkLogic HR standpoint, the reason why I was brought in here is to make sure that that process is transparent, but also so that we can get the fee as competitive as possible for everyone that's involved. Every company that's within WorkLogic HR, that the fees within the plan are competitive. Okay? Yes?
Do you feel when employees now see that or participants see that, they're quite shocked? They've been paying those fees all along, and then now all of a sudden it's on their statement. It's like,
yes.
Oh my God. How can we make them understand that they've been paying that and they're going to pay that wherever they go?
Yeah, that's a great question, because we tried to address that in August when all these fee disclosures came out. Is, hey, you've been paying it, now you know what you're paying, okay? The biggest thing is, what do you get for that, right? The great thing about WorkLogic's plan with Transamerica is the administration fee, which is quite expensive. The plan sponsors don't have to pay that full fee. They just pay a small fee for WorkLogic to have the plan in place. But yeah, it's, they've been paying the fees the whole time. Now it's disclosed. Okay? But I can tell you, we'll see a trend when I come back here in 5 years and we look at fee disclosures and we look at what happened to overall pricing of plans. It will trend down, not up. Okay? So it's going to be good for everybody in here. Any other questions on fee disclosures?
Well, can there be a comparison shown to help her in that educating of the
Yeah, there's 401k like average, the averages that I can send based upon plan sizes and stuff to Ellen.
to highlight what you just said, which is as a whole, our admin fee is less than if we were out there.
Yeah, definitely. Not averages. I mean I can, based upon, and I think $495 is what each plan sponsor pays. The average fee, if you took the average participants in all the plans within WorkLogic, the fee's probably $3,200. So, if I had to guess, but I can get a comparison. So that's fee disclosures. Did you know 94% of investors believe retirement is more challenging now than it was 5 years ago? Do you guys believe that? Yes, you do. Why? Mr. Burke, why?
The yields aren't there.
Yields are not there.
Right. Interest rates are low, so you're not making any money on your money. keeping up with inflation.
Yeah. It's that, even though the market's fully recovered, but it's the fear in the news that we hear every night. It's the fear that, fear itself causes us to do crazy things. So just think about this. Because people completely ruin their retirement plan by fear. If there's a fear that the market's going to falter and completely go to zero, do you think there's anything that's going to be in your 401k plan to take away? It's going to be zero as well. Okay? So I'm going to push you guys to keep that mindset of don't be fearful. Be smart, but don't be fearful. Okay? When the market goes down, don't sell everything. And be conservative. Because chances are the market's going to recover, and about 3 years in, you're going to go, oh, wow, the market looks good. I'll get back in now. Well, now you're buying high and selling low. That's complete opposite. That's why people make money in the market. Is for the institutional investors do so well because people's fear. And they sell low, they buy it, and then they sell it to you when the prices are 30% higher.
They're the ones creating the fear.
Well, regardless of where the fear's coming from,
Don't stop.
yeah, don't stop. Yeah, I mean, it's your account. You can do what you can do. But don't think that you're going to lose all your money, because if you lose all your money, all these products that we invest in, the 401k plans, are diversified within thousands of companies. So if thousands of companies go bankrupt, no one's going to have a 401k plan. Okay? So just remember that. Don't be fearful. Just be smart. Okay? But don't be fearful and don't sell when the markets go down. In fact, when you guys buy things in stores and the price goes down by 40%, do you sell or do you buy? When housings are 40% lower than they were 5 years ago, am I telling you to sell or buy? Right? Same thing. We can't access money until we're 59 and a half, just like our house. If our mortgage company sent us a statement every quarter saying, wow, your house lost 12% of its value. It's a paper loss. It's not a true loss. Just like your 401k when you get a statement every 3 months, right? So don't sell when the market's low. 85% of retirees who eventually made a financial plan regret not making one early enough in their working life. Why is that? Because they don't have time to save enough for retirement. That's why. Because the picture's painted and they're like, uh-oh, how do I save $1,000 a month? I can't. All my expenses are locked in. I got a new car and I got this house, my kids are in college, and there's no more money. That's the biggest thing, is to know what your financial picture is. Do a budget. Make sure you're saving enough for retirement. You should have 70% of your income at retirement. Okay? And then finally, 41% of those in their 40s and 50s have tried to figure out how much money they will eventually need to save. So 41% of people have put a budget in place, or they have some sort of financial picture that's going to allow them to have a goal to get to. Okay? Set your goal. I know I don't want to live off Social Security if it's there at retirement. Right? I want to travel, go see my grandkids, do things. So speaking of Social Security, does it all add up? This is our sources of income for retirement. Well, let's carve out a portion of it. 20% of it, most of us don't have. Unless you work for the government or a really nice corporation. You don't have a pension, which is a defined benefit plan. Right? Social Security it's underfunded right now. It'll be there for, I think everyone in the future, it might not be fully funded. You might not get 100% of what you're owed, but you might get a portion of it. You could say that this is your 401k, and then this is savings. Okay? Really, there's your retirement plan, your savings, and Social Security. I challenge you guys to add one more. Have 4 sources at retirement. Okay? If that's investing in real estate, whatever it is, generate income for retirement. More importantly, maintaining a rate of return that exceeds inflation. What's inflation? Anybody know? What's that?
Increase in goods and services.
It's an increase in cost in goods and services. It's the increase of our bread. And a loaf of bread's $4 now. Right? It doesn't include energy costs, gasoline. So it's about 4% now. So that dollar is worth 96 cents next year. It's worth 92 cents the year after that. So it's decreasing your purchasing power by 4% every year. Okay? So you have to make sure that your assets are above inflation in cash, and then this is the average bond return, which is just above inflation in cash. But you need to get a return that's above that, or you're going to lose purchasing power, okay, for your retirement. So people that are in money markets, if you're not 65, don't be in a money market. Okay? You can be in a mix of bonds and equities. You can be conservative, maybe 50-50, 60-40 bonds and equities. But unless you're real close to retirement, don't hamper and cause your purchasing power to go down over time. Debt. This is the worst thing that was ever developed was a credit card. Pay yourself first. Our government, our economy is driven off of us being in debt, by us spending. It's not driven by us saving. If we all saved, our economy would go down. It's driven by consumer spending. Okay? If there's one thing you take away, it's to pay yourself first. Save money in your 401k plan, your IRAs, after-tax savings in your bank. Pay yourself first. And then whatever's left over, spend it. But this chart shows you less debt equals more money to save. So it will take 29.5 years to pay off a $2,000 credit card debt with monthly payments of $25 versus $125 a month. And this is the interest. This is who you're paying. Okay, 18% probably for that new dress or new pair of running shoes, whatever. Those are expensive running shoes. Really expensive running shoes. In fact, if you want to buy some, I'll loan you the money, you pay me back, I'll charge you interest. That's such a good deal. Pay off your credit cards. It's the worst thing we could do is carry debt and give somebody 18% on our credit card. It's robbery. Don't do it. Put your savings towards retirement. I'm telling you, if you allocate, do a budget, figure out how much you can do, put it in there, you will not miss it. And if you do miss it, you can call Ellen and say, give it back to me. Just try it. Just try it. And contribute regularly. That's the great thing about the 401k is it goes in every 2 weeks, right? It averages over time. Try to contribute the maximum. We need to put away 15 to 20% of our income for retirement. 15 to 20%. 15 is the low side, you want to get to 20. Okay? And that's per person. That's not for the household. That's for your spouse and you. And we're trying to save for college. Right? Daunting. But you got to do it. 2% challenge, never mind that. Annual contribution increase. Try to increase it 1%. The hardest part is trying to get to that 15%, right? 12 to 15, and then try to bump it up 1% a year. You won't really feel that, but you're going to feel trying to get it up to that 12 to 15%. Okay? So, the annual increase is easy, but just try to focus here in the next couple of years to try to get it towards 15%. Yes, sir.
We're obviously fortunate enough to have a match with ours. I mean, are you calculating that in that
Yes.
15?
Yes.
So, in our case, we get the extra, 4% to try to get to 8 to 9 or.
Yep. Exactly. Yep. Good point.
What's the 2% challenge?
2% challenge. I gotta take this. The payroll tax was it when they cut the 2% off the payroll tax. It was a way to get people. They didn't know that they had a 2% coming back to them and less payroll taxes. So finally, if your retirement is in the near future, you should consider, number one, the lifestyle you expect to lead. Like I said earlier, I want to travel. I want to go see my grandkids. I want to take them to Disneyland. I want to go do things. So I know my lifestyle, I need to sacrifice for today to have that lifestyle tomorrow. And I'll be with you in just a second. How does your lifestyle affect your need for income? Directly. That 70% is the minimum, okay? So that's what you should be shooting for. So if you make $50,000 a year, 70% is $35,000 during retirement. Take 70% of your income, and that's what you're going to need to live off of. The way you get to that is the average withdrawal rate's about 4%. So whatever those commercials where the guy's carrying around a number that says 1,234,000, okay? His retirement income is 4% of that number. Because that's the average, that's the normal withdrawal rate during retirement. So I can help you with that. It's real easy. You just have to tell me where you want to be, okay? Investing strategies include asset allocation. Asset allocation are the pre-built funds, okay? Either by your retirement date or your risk preference. We can talk about that individually. How much will you be able to withdraw? 4% is the average, okay? So if you have $1 million saved up, it's $40,000 a year. Tax efficient withdrawal options. Take it when you have zero earned income, okay? So we build up all this money during retirement, and the main reason why we put money into a tax-deferred 401k plan is that we're not paying Uncle Sam at the current income levels that we are during our working life. But the advantage, besides the match or the company contribution, the advantage is paying at a lower tax bracket when you take the money out, which could be 10 to 12%. That's the advantage of being a 401k plan. So make sure when you take your money out that you have zero earned income or as close to it as possible to be in that lowest tax bracket. And then work with a financial representative. I'm sure that several of you have your own personal financial representative. Work with them. If not, get a hold of me. Let me help you out. Let me help you do a budget. Let me help you set a goal so you can achieve that goal. Yes?
Going backwards a little bit, you showed a pie chart, showed the sources of retirement income, earnings, pensions, Social Security, assets. You mentioned also number 12, 15% to try and make that a target. Is that just considered for the earnings portion of those 4 funding sources? Or if you put aside 15% just as a general rule of thumb, you could retire with 0 Social Security? or one of those other pieces?
No, that's including Social Security.
Okay.
That's assuming that Social Security, you will receive, 100% of what you're owed in Social Security.
And that you have a certain average amount of assets as
Mhm.
well, so that's just for that piece of the pie.
Over a 25-year period minimum.
Gotcha.
Yeah. I mean, really the number is, to figure out how much you need at retirement, is how much you have to save and your withdrawal rate of 4%, maybe 5%. So if you can save $1 million, you can, withdraw 4%, it's $40,000 a year, or 5%, it's $50,000 a year. And that's, so plus Social Security. So Social Security's maybe another $2,000 a month. So that's, $60,000 to $70,000 a year. But what's that worth in, 30 years? There's a lot of young people in this crowd. It's going down by 3 or 4% a year, right? So it's, it's better to save as much as you can on the retirement side, because Social Security, we don't know where it's going to be. We assume it's going to be there.
Yeah. Thanks.
Any questions? Great. Just a couple minutes after half hour, so I really appreciate your time. We're going to do this on a quarterly basis. We're not going to focus so much on the markets and where the markets have been. We're going to really focus on different aspects of retirement readiness from here on out, budgeting, different things that we can implement with all of you to get you ready for retirement. So I thank you for your time, and we'll see you next quarter.